folks, Scott here, and this is the wrap for Friday, April 19th. So, interesting and a little bit surprising day because we broke some pretty compelling historical norms today, and I got stopped out, and I'll explain that in a moment. What I thought may have gone wrong, if you will. But let's talk about what Monday may bring us. So, I've shown this in the past, if you followed me for a while, but it's a great one to point out because it's a great big picture nugget as it relates to how the markets work. We are going to close below the 10-day moving average. That's the blue line. This is the daily charts down here. Intraday 5-minute chart here for the S&P 500 futures. So we're going to close below, assuming we close below 1565 roughly. We're going to close below that 10-day moving average. 1567 is where the cash index is right now for the 10-day moving average. Okay, so what happens historically? This is the question I'm going to show you the results for. When you have an unfilled up gap, right, like today from yesterday's closing price, today's gap didn't fill, and you're below the 10-day moving average but above the 200. So you've had some recent weakness. That's why you're below the 10-day moving average, but you're still above the 200. And you have an unfilled up gap. Generally speaking, fading gaps after an unfilled gap is a positive. Check this out, though. Except when shorting, following an unfilled up gap when below the 10-day moving average. So I was just explaining to the trading room late in the session here that the reason this is that folks will see the unfilled up gap today after this recent weakness as confirmation that bulls have stepped in and the selling is over to the downside. And if we get a gap up, they're going to go in that direction, or more likely to go in that direction. Hence, it's a 50-50 chance of filling the gap by the end of the day using an end of the day stop. So that's a 20%, 40% lower number, whatever the math is. It's normally 70% typical gap odds fulfilling, only 50% on Monday. This is not looking at Mondays either. This is just following an unfilled up gap when closing below a 10 and closing above a 200-day moving average. A gap down has a long bias, has average win rate, 70% win rate, fulfilling the gap by the end of the day, and has made money historically. Could get a little volatility after the open, but that's always the case. I'll rerun these numbers for our members in the morning, Monday morning, using our MTG stop parameters, and as always, defer to our gap guides and worksheet before I make my final decision. But hopefully that's a nugget that will help you going into Monday. Now let's look at the setup today. So looking at the worksheet, which is where I always start. In fact, I tried to get long last night because we had a 60% chance of gapping up. These two opening areas, this is the average of all 8 gap guides, versus 40% chance of gapping down, or 41. Didn't get filled on a pullback just to the prior close. So unfortunately, I missed the rally to the upside. But compelling data for shorting up gaps, especially if we open inside of yesterday's highs. Across all 8 gap guys, 64% win rate, 1.3 profit factor. If you see it that good, you can almost guarantee I'm trading it with some size position. In terms of unique day factors, options expiration Friday historically, and I've said this many times, this is a great day in general, on average, to short up gaps. And this data point shows here. In fact, it also greatly favored gapping up. There were no unique patterns in play. So looking at my comments here, I sized it all up. Per last night's video, I did find a risk factor. Up gaps after a 50-day moving average down straddle. That means closing below the 50-day moving average after closing above it. Went above the 200. Been a little bit weak. Well, I'd call that neutral to maybe slightly weak. I'd call that neutral personally. Average gap with our MTG stop parameters fills about 60% of the time and has a 1.0 profit or 1.1 profit factor. It's a little bit weak. Found another scenario, and this is a pretty obvious one, fading small and mid-size up gaps, defined as less than 40% of the 5-day average true range, or the ES opening below basically 1545, after at least 4 consecutive lower daily highs when above the 200. This is common sense. Let me show you what I mean. We're in a bull market, but look at all this weakness. That's the cash index there. It will be more obvious in the daily chart. Right, so that 1, 2, 3, 4, 5 consecutive lower daily highs. You get a gap up, folks are more likely to lock in profits that have been short, and that provides a little bit of the bullish bias. However, when I sized it all up, options expiration day is such an unusually and consistently strong day for shorting up gaps historically on decent, pretty good sample sizes. And I've got the gap guides showing technically good setups today. In fact, the market condition was the only flag that was neutral, and that wasn't bad. See, the ES, I'm not going to look at all of them. Market condition, DOC zone, opening between prior open and close, slightly attractive. 3-day pattern, strongly positive. Seasonality, meaning basically Fridays, strongly positive. Weighted average, strong numbers there. Confirmed by the ETFs. And confirmed by basically all of the other indices. I think 7 of the 8 had similar numbers to this. So this is one of those setups you just can't pass on, or I can't pass on. You should not overthink. It'll cost you way too much money over the long term. So I traded it, and my comments show that as long as we opened less than that 1545 area, and it was at least 1 point above the 4 p.m. close. We had some selling after the cash indices closed at 4 p.m. yesterday that resulted in the regular close being around 1535, or the futures close being around 1535. So I didn't want to trade with the cash indices basically opening flat or down. So never do that on the small gaps. And it's pretty standard, at least 2 of the 3 futures, because I don't know where we're going to open. I'm typing this up around 9:10. So I said I'll fade it with a slightly reduced position size, 75%, primarily targeting gap fill. So I was accommodating this risk here. That ended up being a great thing. Now the gap size, and I reminded people usually just position size to count for bigger stop size. Per the gap guides for the ES today was a 7.25 or 7.5 point stop. So I went short at the open. Was filled at 1540 and a quarter. 1540 and a quarter. So I got a tick of positive slippage there. And my target was 35 and a quarter. I thought about taking some off at 37, but I didn't. 35 and a quarter for the majority of the position. I was going to take off some extended target. And as luck would have it today, everything filled their gaps. Nasdaq was flat, or actually opened down a tad. I actually didn't realize it opened down. It wouldn't have changed it. 2 of the 3 still opened up. It was a strong setup. But you can see how the Dow sold off, the Russell sold off, the ETFs all went and filled their gaps. See the spider filled precisely. Diamonds were acting goofy. I think it was IBM, whatever. Bottom line is, this one didn't work. It traded down 4 points from my entry to 36 and a quarter. So it went 80% of the way towards its target, which triggered my proximity rule, which is if the gap is 4 points or more and it comes within a point, then my proximity rule allows me to take profits, tighten my stop, whatever I need to do. So I hashed back and forth, quite frankly, in the trading room on the right way to do this one, because the data was such a solid setup. And I don't like over managing the really best setups. Too many times I've tightened my stop only to be stopped out before it rolled over. So this time I tightened it ever so slightly from its 7 1/4, 7.5 points down to 6 points. So that was down to 1546 and a quarter. Put it, I think, a tick above there was a pivot level up here, and above Globex highs. And I was stopped out, -6 on a trade that did 80% of what I expected to do. That is called a Buffalo trade, after the great city of Buffalo that's had a bunch of near wins in the Super Bowl and so on multiple times. I hate them. Unfortunately, they are technically unavoidable if you think about it. There are always going to be scenarios that narrowly miss hitting your target that can become losses. And my trading plan was set up to protect me. As I've gotten more experienced over the years, doing this almost 10 years now, I allow myself to make judgment calls. I made a judgment call today, and I don't really regret it. I'm being honest. I think that it was worth the risk. I've made so much money, and if you don't believe, start a trial membership if you want. You'll have access to over 1,000 videos I've done over the past 5 years. Search, or if you remember, search the video archives, our probability video archive, and search for options expiration or OPEX, and look at all the money we've made. Not just me, I mean, a bunch of people. It has been a tremendously profitable setup. So I don't have any regrets about this. Did the right thing. Inside the DOC zone, you'll get a little choppiness sometime. Stuck with my plan, lost 6 points. Start off 3/4 size, but because I was able to reduce it a little bit, I reduced it 20%. The stop size, and it'll be about a 60% of my normal full positions or full position size. So not that painful, but still disappointing. So the range guides didn't really, they were very mixed for 15-minute and first hour ranges, the magenta lines as well as the gold lines. So I did no trades on those, did no other trades whatsoever, and called it a day. So that was my day, and looking forward to next week. Still wasn't a terrible week by any means. I did some really good trading on those range trades and avoided all the other unfilled gaps this week. So a little disappointed to end like this, but that's called trading. So we'll see what next week brings us, and that is the wrap for Friday, April 19th. Have a good one.